Hi, I'm David Maurice, Certified Financial Planner with CMW Wealth Advisor. Today in our monthly Money Pulse, we're going to talk a little bit about historical perspective for long-term investors. Many of you know that we've crossed over this past summer the longest economic expansion in the United States in history. The one previous to this, taking that record, lasted from March of 1991 to 2001. Of course, this was after the tech bubble burst in about March of the year before that, 2000. So this expansion that we've experienced, along with the bear market, bull market, which has continued since last August, crossing over the longest bull market in history, we're in very enduring good times, although not always appears to be. In fact, the media would have us totally connected with the ups and downs of every moment, certainly the ups and downs of every day, and the news cycle just doesn't take us much past that. So today, a little bit of historical perspective. Those are two pieces right there. Bear markets and recessions don't come because of expansions or bull markets dying of old age. They both end in circumstances that can be seen from historical perspective to have causes. Another item that goes along with this is that bear markets and recessions are linked, but they're not inseparable. We have periods of time where we'll go into a recession and there's no accompanied bear market. There have also been bear markets with no recessions. They are frequently tied together. They're usually delayed, one coming before the other, but it's worth noting that not every recession brings with it or is brought by a bear market or the other way around. Now, an interesting thing that we noted this past year is in September, the high mark for last year's performance on the S&P 500 came to a screeching halt, first tumbling in October, recovering a little bit, falling again in November, recovering a little bit, but not recovering from the highs of September until on December 24th, Christmas Eve, the market finally came down for its last gasp. And it wasn't until we got into the spring, or at least in the late winter months, January, February, and finally in March, that we could actually see this downturn as the strongest and sharpest downturn in the market's history, accompanied by an equal recovery in over 30 years. In fact, it was Black Monday, known as such, from October 19th of 1987, when the market came down that much, 20%, in one day. We don't remember from that history, most of us, that tumble was recovered before the end of the year. And that's the reason we mention it. There was no recession. It was a bear market technically because the market dropped 20%, but in terms of enduring grinding and discomfort for investors, it was recovered, and the Dow Jones was actually positive before the year end. In this most recent example, we can find nothing going back until all that way to 1987 that was this sharp a downturn. The S&P 500 or the Dow, looking closely with dividends included, did come down a full 20%, just barely, but that's technically a bear market. It also recovered before the end of this year, which we're still in now, and it did so very sharply. These kinds of things should be kept in mind for long-term investors because every downturn and every recovery is different than the one before. When we see the kind of volatility that we see now, and we know that the backdrop is that we have this extended expansion and extended bull market. When does this all come to an end, and what will I do, and how will I take care of my account? So we remind our listeners and those who follow us, our clients and friends, that you should always be invested in the stock market for the long term. Now, it's different for everybody, and you should be diversified in such a way that you can absorb a significant downturn, even a significant downturn lasting a long period of time, such as we did have back in 2000, such as we did have in 2008 and 9. These are regular, recurring cycles. They're unpredictable. And as we've said, they may come with recessions, they may not. But as we can see from two examples, though 30 years apart, you can have severe downturns. They can last a long time, like in 2008 or in 2000. They can be accompanied by recessions, or they may not be. But even if you're approaching retirement, we contend you should be invested, heavily invested, in stocks. Maybe at least 50 to 60%, maybe more. Because what most people don't realize is your income that you may be depending on from those assets has to last longer than you. The alternative is to plan for it to last only as long as you and be sure you run out on your last day, which is not a very realistic prospect. So instead of planning to run out on your last day, you have to plan for your money to outlast you, which unless you're 75 or 80 or even 85, that's going to be, unless you're sick or have some genetic indication, you could be living 15 or 20 years beyond even those ages, which is long term. And long-term markets do tend to show far better returns than in any other place. So this is your monthly Money Pulse from David Maurice, Certified Financial Planner of CMW Wealth Advisors. Thank you.